Okay, let's get started. Spreadsheet risk modeling. First question I think one probably should ask is, why do we need to add risks to your model in the first place? Well, Excel spreadsheets are really useful. I think we've seen how popular they are. It's extraordinary how many different areas they're used in. And in my work, in the consultancy side of my work, I've seen spreadsheets built to do all sorts of things. From, in fact, build a trading floor for a bank, unbelievably, to doing epidemiological simulations. A model I wrote recently was to simulate ships moving about through a wind farm, trying to rescue people who had had an accident. So spreadsheets are extremely flexible. They're great in many ways. So they're easy to build an analysis, easy to update, easy to check, easy to share it with your colleagues because nearly everybody has Excel. And there are a lot of supporting tools that people don't make a great use of. But there's the old boss of Excel development team once told me that 90% of people only use 10% of Excel. The problem is it's always a different 10%. And I think that's really right. You know, some people use pivot tables, some use VBA or C++ add-ins, etc. But there's a lot of supporting tools, and it allows you to create a very flexible modeling environment. But the problem with sort of business risk modeling, business models that one has doing cash flows, etc., is that if any of those input values to your model are uncertain, the calculated outputs will also be uncertain. The question is, of course, how uncertain? The biggest question that people should be asking themselves is, would the uncertainty actually affect the decision that I would make? So Monte Carlo simulation within Excel, it lets you add uncertainty into your models, and there are three parts to it. You replace the single values in the model with uncertain values, and this is done using probability distribution functions. These are functions that randomly generate values. In place of a single one, they generate a range of possible values, and the trick there is that the values that they will appear during simulation with a frequency that is proportional to how likely you believe they are to occur. That's where all of the probability comes in Monte Carlo simulation. Second stage is that you run the simulation, which is running thousands of different scenarios. And then finally, you review the results and you consider your options, make your decisions. So let's go. The Achilles heel of risk analysis. There tends to be something of a block. We meet a lot of people who use our software and they're doing great risk analyses, but then they present it to their management and it's got a probability distribution and some statistics, and management are not comfortable with this. They like it when you say there's an NPV of 70 million. They go, that's great, go ahead. If you say the NPV is between minus 140 and plus 210, they're not so happy because it's not such a clear-cut decision. So management not comfortable with the results, and that's good. They should be aware that the result of a decision can be unpredictable, and they should be trying to build that in. But we need to train them. It's easy to train the risk modelers, and probably nearly all of you are sitting in this audience are risk modelers. It's the risk managers, or the managers in general, who need more training and need to feel more comfortable about the risk analysis. So we do actually offer courses for risk managers, and they last one day in order to help people understand how to use risk analysis results. So maybe talk to your risk manager or your manager about attending such a course if you're having these problems. There are a couple of other problems with risk analysis models. It isn't as simple as simply changing a number for a random function, something that generates random numbers. It's more complex. First of all, it's asks more challenging questions about the structure of how things may or may not go wrong. So, for example, you could have a risk event that occurs, and that might really affect lots of things in your model. You need to be able to build in the logic that says, if this risk event occurs, then, and everything changes. And that makes them for a more complex model. The risk analysis models are less easy to follow because they're a bit more complex, but also because the numbers keep changing. People hate that. When you hit the F9 key, you're seeing different numbers. It's difficult to track. They're less easy to check because people don't really understand probability stuff as well. And of course, it's easier to make mistakes because you can't check it as easily and it's more complicated. So you should bear in mind also that Excel models will need to be rewritten a bit. You cannot just replace a number with a simulating function. And perhaps even more importantly, some of the plus, minus, multiplication, division logic that we typically use in a spreadsheet when we're adding columns and rows, they may no longer apply. And we need to be very aware of that. And that's something that I'm hoping to deliver during the course of this webinar. A little pitch, forgive me. So we've got ModelRisk down here. This is one of the products that we produce within our company. We have Tamara, which is a project risk analysis software, which I presented in the previous webinar, along with the ideas of why we should do project risk analysis. And you should be able to view that webinar if you didn't attend it in a few days' time when we put a recording on our website. Tamara connects to ModelRisk, which is our spreadsheet risk analysis software. So you can use the results of the uncertainty in the project duration, finish date, the cost. You can build them into a spreadsheet risk model. Tamara also pulls off information from Pelican. Pelican is our enterprise risk management software. It is the repository that will hold all the information for a company, organized by individuals, organized by business entities, etc., etc. It analyzes, it holds risk management strategies, it makes sure that those strategies are being followed, it provides reporting, it does a great deal of things. If you're remotely interested in enterprise risk management, then please do contact us and we can send you some very detailed explanations of what Pelican can do. One of the things that Pelican does is it will take the information from Tamara and feed it back into Pelican. And it also does the same thing with ModelRisk. So you can collect the latest information out of Pelican, the latest risk, and you can bring them into ModelRisk, and then you can flip it back. So you can have ModelRisk models sitting within Pelican that your management can directly access. And by access, I mean that they cannot alter any of the logic of the model, but they can run scenarios on your model. They can review the results directly within their web browser, etc. So this is both a way of ensuring that all the models are using the same assumptions, the same estimates of risk, and that the information is being made available not just at every quarterly meeting, but whenever the management feel the necessity of finding out that information. And I will show it a little bit. Tomorrow also connects into ModelRisk. So I'm going to go show you an example of that. Okay, so we have ModelRisk, which is what we're going to be using today. We have ModelRisk Cloud. This is a separate, if you don't want to go whole hog and get a Pelican Enterprise Risk Management, you can also have ModelRisk Cloud, which will allow you to put all of your risk models onto your intranet, and then managers, depending on their access rights, can go and look at the results, see the updates. The models can be run according to a schedule. You can also store basic assumptions within the ModelRisk cloud. So for example, if you've got a forecast of exchange rate going out the next year, you'd like everybody to be using the same exchange rate forecast, and you can make that happen using ModelRisk cloud. The results viewer is a standalone application that you can also find very useful if you are trying to share your results with colleagues, but you don't want to share the model, and you don't want to share, and they don't want to install ModelRisk. ModelRisk has embedded in it a copy of the results viewer, but also you can download it from our website, and it will show you all of the, if somebody sends you a results viewer file, they will open it, and all of the graphs, these are all electronic graphs, as we'll see in a minute, they're all formatted according to whatever has been defined within the model. So when you make pretty graphs, you format them. When you save it, your model, it remembers the format that you've asked for. Next time you run the model, it will show you the same graphs. When you save it, send it to a client or a boss or whatever, they will get this exact same results view of all the different graphs. Right. So let's look at first simple model to get us started. In this webinar, I've assumed that people have not got any knowledge about risk analysis at the moment. So we're going to start with the very basics, and we'll move along fairly quickly. So here is a standard use of a spreadsheet to figure out what the total cost should be for some project. So in this case, we're going to build a house, purchase the land, lay the foundations, etc., fixtures and fittings. We add them up. The total cost is $312,000. Now that's all very well, but wouldn't it be nice to know if we've got a certain budget, whether with all the uncertainties, we really will have enough? So how are we going to do that? Here is the same basic setup, but I've added in here some uncertainty. So the best guess are the same values that we had before with the same 112,000 or 312,000, but here I'm putting in a minimum and a maximum. So 125,000 is my best guess, but it could be a minimum of 100,000, could be a maximum of 140,000, and so we work our way through the list. So once we set up these three columns, we can interpret them with a probability distribution. And here is one example. So I can show you what this formula looks like. It's made up of two bits. First of all, we've got this bit here, which is a triangular distribution. The word Vose, because we're using ModelRisk here. Vose is any function used by ModelRisk, takes the four letters Vose in front of it. And then the type of distribution, a triangle. So let's just get rid of this. I'll go into the ModelRisk menu. You can see this here. And if I click on View Function, it will show me this triangular distribution. You can see that we had minimum 25.3 sitting there, most likely 26.1. That means it's the value that has the highest probability of occurring, and then a maximum of 27.7. It couldn't be higher than this number here. That's one way of viewing the information and interpreting it using straight lines to form a triangle shape. Another way is looking, instead of how relatively likely these values are, but look at the probability of being less than the horizontal axis value. So it starts off as 0 in this cumulative curve, and it makes its way up to 1. So there's like a 50% chance or something like that you're going to be less than this number here. You can see some statistics on the right. So all the distribution details that you might be interested in will all appear in this little window. If I expand the windows, so the number of percentiles also increases, so we get all the information we might want. Okay, if I didn't have that distribution there, I could have just simply inserted it in a number of different ways. I could write equals Vose triangle. And I could have Control A, by the way, if you don't know how to do that, I could have simply put in a minimum, most likely a maximum, and gone OK. And there would have been nice if that was formatted differently. There we have a number. The numbers are different. Here's something you'll notice. This is a triangular distribution, the same triangular distribution as this one, but the numbers are different. There's no reason they should be the same. They just came, they're random samples from exactly the same probability distribution. So I could have entered that distribution using this method. I could have also entered it by just going into the ModelRisk menu and then going to select distribution, and depending on the version of ModelRisk that you have, a basic or complete, you will have a different set of distributions to choose from. This is a complete version, so there are a lot of distributions. I believe I know it's the ModelRisk has more probability distributions than any other spreadsheet add-in on the market. And okay, you're not going to use 80% of them. 20% of them you will use. But the thing is, depending on your industry, that will be a different 20%. So in the end, you'll be happy that we have all the distributions that you're really after. They're categorized in different ways. We can look in here in the subjective list. And so subjective, because it's not based on some mathematical model, it's just based on opinion. We can pick the triangular distribution. We can put some numbers in, 2, 3, 5, whatever. And we can go and insert it into the worksheet. And so you see there, again, horrible formatting. But we've got a triangular distribution with that input information that's been put straight into the model. Okay. Once we've got the distribution in there, we also, because we're interested, in the end, we're going to be interested about how much windows and doors are going to affect the total cost. So we need to define two variables. One is an input, and or two types of variable. One is an input, one's an output. So I've already set this out, but here, this is just a triangular distribution. I want to tell ModelRisk to remember the simulated values, and we're going to see why in a minute. So I need to go into ModelRisk and click on the input-output section. I go mark input outputs, and I'm going to select an input. I give it a name. Well, what name would be suitable? This would be a suitable name. Okay, and if I just click on OK, you will see that that formula has now changed. It now says equals Vose input, the function that we want, and it's referred to that cell B7 as the label, and added that onto the triangular distribution. I could have also, let me just delete that again. I could have also added some more extra information in there. If I want to go into input, and this can be quite useful, I make it as an input. I'm going to give it a name. Okay, but I also want to give it a units. So what units we're dealing with here? We're dealing with thousands of dollars. So I'll put in $K. Okay. Now you will see that the Vose input has added an extra parameter. The extra parameter being the units that are being used, and that can be quite useful. So we've got this model all set up, and in the end, we've added them all together. So here I've added all of these different values, and to figure out what the total is. And if I hit the F9 key, you'll see the numbers are changing. So if I run a simulation of, say, 5,000 samples, what's going to happen is 5,000 times it's going to sample from this distribution, these distributions, and it's going to give me histograms, nice graphs on the results that are generated from remembering the output data and all of the input data. But let's just make things a little bit more tricky before we finish. Let's say I've got two options. We've got purchasing land. I could wait. I'm not sure. All right. Somebody has said to me, they'll sell it to me now for 125. But, you know, it might, if I wait, maybe it's going to be down 120. But also it could be up as high as 140. So is it worth buying it now for 125? Well, I think it's fairly obvious. It's yes, but let's just confirm that with a simulation. So what we're going to do here is we're going to, first of all, define option 1, which is you buy it now, 125. It's just a number. Then over here we have option 2, which is the triangular distribution. So taking from these three values. So if the price is uncertain, it could be this number, it could be something else. And in this cell here, what I've done is I've added a Vose sim table. The sim table function allows me to say, I want to run multiple simulations, 2 simulations in this case, and I want to compare the results from running one simulation where the price is fixed and another simulation where the price is not fixed. So how do I do that? Well, the sim table says, give me a list of values I should use in this cell. So we can just forget this part for the minute, the sim table. And it's saying, I want to use these 2. So it's going from C18 to C19. And it's also, the second parameter is, and what do I use when we're not running a simulation? Well, I want it to use this second variable, second parameter here, which is the random number, so that when I'm hitting the F9 key, I'm seeing the numbers change. If I change that to, say, this, the fixed value, then it would just be showing the same number because we're not running a simulation yet. Okay, so I'm back in the model. I'll explain this little, this part of the model in a minute. Now, I want to run a simulation. So we've got our spreadsheet, we've restructured it slightly, as you can see. We've added the uncertainties in the model, and now we want to run a simulation. Right, so how do I do that? First thing you do is go into settings, and in settings you can define the number of samples, 5,000 in this case, and the number of simulations. I want to do 2 simulations, 1 for each of these, but let me just set this back to 1. Let me delete this. All right, so this is what it would normally look like, 1 simulation, and you don't have to give a name. But I'm going to change this. I want to do 2 simulations, and I'm going to say these are the 2 scenarios that I want to take the names from. So you can see that's written in there now. Now, if you are running multiple simulations, and you're comparing the results, you want to make sure that when the 2 sets of results you'll get have a difference simply because of the different structure of the model and the different numbers you put in, not because of any random sampling. So to make sure that happens, we control the seed value. The seed value is what starts off the generation of the random numbers in your model. So I'm going to use a manual seed value, not a random one. I'm going to use 1. I always use 1 personally, but pick a number, pick your date of birth or something, 190962 in my case. I could pick that. If it's a number that you remember, is pretty good, because it means if you go and have to redo the model, you can resimulate it with the same seed. You're going to get the same number. It's a matter of habit for me that I always use 1. Okay, multiple simulations are all going to use the same seed. So they're all going to use the same seed of 1, which I've set manually, of course. All right. Okay, so I've set that all up. I go OK. And now I want to run the simulation. So if you look on the bottom of the screen, you'll see it's finished model number 1, it's finished model number 2, or scenario 1, 2. And as a result, it comes up with a bunch of graphs. This is the results viewer. I mentioned that this is shipped with ModelRisk Basic, ModelRisk Complete. You have all exactly the same capabilities, and also it can be a separate product if you want to share your information with your manager or your client or whatever, colleague. Okay, so how does this work out? You've got you have a home tab, with a bunch of things about copying, printing and zooming and creating standard reports. For example, you can send off a report to MS PowerPoint, Word, PDF, put it in Excel, and you can look all sorts of different options about what it is that you want to put into that report, and you hit the button and it will generate, excuse me, it will generate the results in the format that you specified. Okay. So we're going to look first of all at the graphs. I've got a bunch of graphs here. I could always add a graph. So how do we put in a graph? We go Insert, and then we select the type of graph that we're interested in. So perhaps we're interested in a spider plot. So it inserts a spider plot, and once we've done so, then we have a number of different controls that we might want to look at. A spider plot is a relationship between a particular output and a number of different inputs. So we need, if we had several outputs, we would need to select the output according to the spreadsheet It's all organized according to spreadsheet. And similarly, all the inputs, we could select these and see what the effects are. So we can switch some of them off and see what the results look like. And this is just telling me about how sensitive the mean of this particular output is to variations in the inputs that we're looking at. You can also delete it by just clicking when it's the live window. You just click on this button here and that goes away. All right. Let's go back to the first one. The first one was a histogram. So all I'd done is I did insert histogram like this. And then you'll see that we've got here number of simulations. There are 2 simulations we ran. Option 1 buy now and option 2 wait. So if we just have option 1, we can look at the total cost probability distribution for option 1, and we can, if we wish, add option 2 to that. We're not restricted to just looking at outputs. We could have made it, instead of the total cost, we could look at constructing rules. We could have, so constructing rule, you'll note that the distributions are exactly the same. They're overlaid one on top of the other because they're using the same random seeds. So that's a nice accidental, but a nice confirmation that the seed is working, because exactly the same random numbers have been generated for both scenarios for that variable. It's the only difference between them was going to be whether or not we buy the land. Okay, so we can switch it back to total cost, and the graph is a bit garish now. All right, we have sliders, so we can look and ask certain cumulative probabilities. We can, under the options, whenever you're looking at a graph, you will always see that the options menu changes appropriately. So here we're in the histogram. You see it's all the histogram options. We can not show the sliders, we show them. We can edit them. We might want to put a value instead of a probability. So here we've got a value of, say, 310. Apply that, and you'll see that here 310 is being shown. We've got on the right hand side tables where you can see all the different statistics you might be interested in. Okay, so basic histogram plot. How did the histogram plot appear in the first place? Well, it's a simple thing. All that happens is that all of the numbers that were remembered because in the function, this function here, if you remember, had a Vose output. Because it had Vose output, the ModelRisk remembered every simulated value, and then at the end of it, it just produced a nice, visually interesting histogram of that information. We can also look at a cumulative plot, and here what we've got the 2 cumulative plots together. This is if you're trying to compare 2 distributions, the cumulative plots are far easier than looking at histograms. So here we're showing them both together. That's just simply inserting a cumulative and then selecting both simulations for that particular output. Okay. So what can we see? We can see that here, this distribution on the left, here we're talking about total cost. The probability of being less than some number, like this one, probability of being less than 315, well, that's greater for the total, for the red line, where you buy now. At almost every single number, so almost always, we are finding that the probability is costing us less than $315,000 is higher if we buy now, or 318 or 320 and blah, 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 etc. This curve here is almost always higher than the other one, which means that under nearly every possible scenario, except for these few scenarios here, we are much better off buying buying right now. And that's not really that surprising, is it? Because this is 125,000 fixed, or an uncertainty which is biased 5 less than 125,000, but 15 more. So that distribution is going to be quite skewed. If you look at the distribution over here, you will see there's a much higher probability of it being more than 125,000 than it being less. We can see a view function, and you see 125, you can see that the probability of being lower is 25% odd, so 75% chance that it's going to be more than 125,000. All right, so go back to our results viewer. Where are you? What other charts can we produce? Well, we've got a tornado. The tornado is telling me for, here we're going option 2 wait versus option 1 buy now. Let's see, purchase land, if we wait, that is the largest driver in the uncertainty about the mean of my output, which is the total cost. So in terms of roughly where is the total cost sitting, where it's sitting is mostly or largely driven by purchasing land. What happens if we buy now? Would that graph look any different? Let's see. It's gone. So purchasing land here, it has absolutely, as you'd expect, has no impact on the mean because there's no variation. We've fixed it 125,000. It does not contribute at all to the uncertainty. So a nice little illustration. We also have a box plot, and box plot is very nice for describing, particularly if you've got several different variables, and you want to just have a scan to see which ones are bigger and which ones are smaller. So for example, I could, let's not use this, or just go for option 2 wait. Instead of that, I want to look at this is the all of the different costs that we had, the constructing walls, etc., etc. So you can see, relatively speaking, fixtures and fittings has a greater uncertainty. That purchasing the land that has the largest, you can see not only where they sit in absolute terms, but how relatively uncertain they are. Of course, you need them all to be on the same scale, and ModelRisk automatically checks, because in this graph, they could be on quite different scales. One could be tons of metal, another one could be tons of sand, you know, or amount spent on cleaners. And they could be quite different units. So ModelRisk checks this to make sure they're all the same units. If they are, it writes it down. If they're not, it will tell you, warn you that they're inconsistent. We've got a scatter plot. A scatter plot is, I've always liked scatter plots because they not only give me some sort of sense of the relationship between an input variable, in this case fixtures and fittings, and the output and total cost. So I can see, I can change the number of points to all. You can see that pattern better now. But it also, I find it to be a very useful tool for checking that the model is really working. Because sometimes you have cutoffs where if it's below a certain value, you do one thing, otherwise you do another. And you can see these sorts of things appear in the patterns of the dots. So to my mind, scatter plot is perhaps most useful for the risk analyst to check his model rather than the manager, but it does depend on the technical capabilities of your manager. Finally, I'm just going to show you this embedded Excel report. So this has been pulled. You can see behind the scenes, if you can, whoops, I didn't mean to do that. You can see that underneath there is a spreadsheet with this same information here. So what we've done is created in this model, you've got under inputs, outputs, I can add a simulation embedded Excel report. So for example, I could add a report like this. I say that I want this to be within the results for your report, and then give it a name and go, okay, I want to do that because it's not suitable for this particular example, but it was done here, and you see the name was called targets. And this is telling me, it's a little summary of some information that I might want to have, because there can always be a number of different statistics that you want to particularly record from your own model, like the probability of exceeding a particular value, the probability of lying between 30 million and 35 million, etc., etc. So it's nice to be able to have a report that you can create all for yourself, and that sits directly in the spreadsheet and will automatically be shown in the results viewer. So this is done, as I showed you, by in here in the Add Simulation Embedded Excel report. Here we've got the one that was already there. So you can see there, this is the report that I had already created, that range, excuse me. All right, and that's why this appears in the results viewer. Now, the simulation results, you can see that what it's doing is calculating under two different scenarios. I go buy now and wait, and it's telling you the probability that you'll be under budget. Here's my budget, 322 million, or 1,000, pardon me. This was my best guess, was 312. Added a bit, 322, that's my budget. What's the chances of being under budget? Well, let's have a look. How is this done? You can see that here is a simple function, Vose, sim for simulation. All of the functions that report values at the end of a simulation have the word sim in front of it, and then probability. So this is looking at the probability, and then that this variable here, which is the total cost, will be less than or equal to this variable here, which is the budget. And then the one, it says which simulation run do you want to refer to. So here, because it's option one was buy now, that was the first option, I write down one here, and I've got exactly the same formula in the next one, but it says 2. So I can say I've got a 98% chance that, so basically 100%, that if I buy that land now, I will come under the budget. But I only have a 70% chance of coming under budget if I wait. And I think that can be a very useful, if you're a decision maker, you want to just say, no, you want to come under budget, we've got two options for you. Pick one of these two. I think they'll know which one to go for. At the same time, we've got the initial estimate. I just thought I'd add an extra line in here. This is what the original estimate was. And we're asking ourselves, what's the probability that we would be under that initial estimate? So for sim probability, same idea, 1 and 2. You can see, now this is strange. There's only a 7% chance, if we buy that land now, that we'll be under the initial estimate, and a 6% chance if we wait. But this is nowhere near like the 50-odd% chance that we maybe would imagine, because these are our best guess estimates. But the problem is that in every turn here, we are finding that there is more opportunity to cost more than to cost less than this best guess. So if I view function here, you can see there is, to some degree, there's more area to the right of my best guess than there is to the left. More probability that I'm going to take more, it's going to cost me more than my best guess, and it's going to cost me less than my best guess. And this is perfectly natural, because when things go wrong or things change, they don't generally change in our favor. Things get more costly, they take longer. It's not often that we're lucky. So when you add up the probability that there is a more than 50% chance it's going to cost you more than the best guess for each of these variables, it becomes less and less likely that in combination you're going to come up with a total cost that's less than your original best guess estimate. And this is perhaps one of the greatest advantages of risk analysis, is that it gets you a little bit more realistic about what really the cost might be. So those biases that we can't really estimate by simply having a best guess, we can do, and with some explanations behind them, by doing Monte Carlo simulation. If I just look at those results again, we had the histogram, we have 312. 312 is sitting here. You can see that there is only a small number of samples that were generated below that 312 value, and there was an awful lot that were higher. Okay, so that's my first model, which I will now close. And we'll go back to the risk analysis webinar lecture. I've got 15 more minutes. So basic risk modeling process, Brainstorm for a list of key risk events that might affect your business plan that you're building a spreadsheet model of. Consider the key uncertainties separate from risk events. Risk events are something that may occur and may not occur. And so you must be able to simulate that they have an impact of 0 because they didn't occur, or they have a non-zero impact because they did occur. Uncertainties, on the other hand, are things that are always there, but we're just not sure what the number's going to be. So we know we're going to have to buy a tractor or we're going to have to buy land. We're just not sure what the cost of that land might be. So apparently you have to do it twice. Should have edited that. Okay, you have to restructure your model, put in the uncertainties and the risks. These 2 bullet points should be reversed, I suppose. Then we label the inputs and outputs, as I've already shown. We run the simulation and look at the results. All right. So distributions. What distributions are we going to use? Well, I've committed something of a sin in that I've shown you using the triangular distribution in the first example. In fact, the triangular distribution for me is one of my least favorite distributions. And the reason for that is because it doesn't really have a lot of a shape that really naturally reflects the real world. Like, it's not, when you look at a triangular distribution, it has a straight line that goes from the maximum to the most likely. So it tends to massively overestimate the extreme values, especially as these extreme values are ones that we tend not to know as well as, say, the central value, or as well as the minimum. The maximum is very hard to know. So a 3-point estimate is a much better way of doing things. 3-point estimate, you put in the minimum, the mode, some high value, and then a chance of being below that high value. So in this case, a high value is 7, chance being below, 90% chance you're going to be below 7. You can see that line there. That's better than asking the question, well, how big could it actually ever be? Because, if you told me, right, how much is it going to cost you to renovate your kitchen? And wow, it's going to cost you 30,000. Well, could it possibly cost me? Well, yeah. Well, could it cost me 35? Yeah, I suppose. 37? Yeah, I suppose. 38? Yeah. It's like a bidding process. You could end up, well, I suppose if, everything went incredibly wrong, it could cost you 60,000. It's just not very likely. Well, if you keep asking for that maximum, you're never going to get a realistic estimate. And the triangular distribution takes a lot of notice of what that maximum value is. So I prefer that one asks these minimum, mode, and high value. Excuse me. And this is one of the distributions that's within ModelRisk. For those of you who are on a budget, it's not in the basic, I'm afraid. It's in the complete. All right, discrete distribution. This is a typical distribution, very, very flexible and useful. It's just for a number of different scenarios, like how many bridges might we have to build? We might have to build 4 or 7 or 8 or 17 or 20, and you assign some weights, so they don't have to be exact probabilities, 24, da, 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 da. And so what happens is that ModelRisk will randomly pick one of these as being a possible scenario. It could be 17 bridges, it could be 20 bridges. And it will randomly pick them with a weight, with a probability in proportion to how you assign these weights. So it will be 20 divided by the sum of all those numbers. It's a fraction of times it will pick this, which is about 20%. It's a very useful distribution. The Bernoulli, named after Mr. Bernoulli. He was one of the inventors of probability theory way back in the 1700s. And it's kind of sad because Bernoulli, he invented a hell of a lot, but he just got the world's simplest distribution credited to his name. It is either 0 or it's 1, and you give a probability of it being 1, say 70%. Well, then the probability of 0 is 30%. We'll name that Bernoulli. I think in hindsight, we should have maybe given him a bit more than that. Like, he invented the binomial distribution, for example. Should have had that one. Anyway, the Bernoulli distribution is wonderful because it allows us to model whether a risk occurs. 0, no risk occurs. 1, risk occurs. So if you take this Bernoulli random variable function and multiply it by a distribution function for the size of the impact, it's going to be 0 whenever the Bernoulli comes up with a 0, or it's going to be some impact value whenever it turns out to be 1. Super useful distribution. There's another famous mathematician called Poisson, French guy, and he invented this distribution, which is the distribution of how many randomly occurring events there might be when on average in a certain period you expect this number to occur. So if on average you expect half an event to occur a year or one event to occur every 2 years, then how many events will occur in the next year? Well, it could be 0, it could be 1, it could be 2. The mean of this distribution is going to be 0.5. So here's Poisson 1, here's Poisson 3. You can see, in fact, as this distribution gets larger and larger, these means, so it looks more and more like a normal distribution. But this is also extremely useful for modeling random events like risks that can occur more than one time. So things like a strike or tornado or an accident. So the Poisson distribution is extremely commonly used in that situation. Right, well, that was pretty easy, wasn't it? I just gave you 4 distributions. To a quick reminder, we've got the 3-point estimate, the discrete distribution, the Bernoulli, and the Poisson. And honestly, if you know those 4 distributions, then you're halfway to being a risk analyst, if you can use them well. Those are the 4 distributions that you can do a great deal with, and they can give you a lot of modeling power. So I strongly recommend you try and make yourself familiar with them. Right, well, seeing as I've shown you those distributions, I think it's a nice idea to actually apply them in the real world. I've got another 10 minutes to go. So here I've got a risk register. Now, please don't groan. I'm sure all of you have seen risk register before, and you either love them or hate them. Well, in this particular case, I don't particularly love them, but they're a good stepping stone. And some of the things they do are the very beginnings of what the Pelican software will do. Pelican has a whole strategies about how you can reduce the likelihood and the interactions between risks and et cetera, et cetera. But for now, let's have a look and see if we can understand this. Right, so we've got just 7 risks here, which rather unimaginatively I've called risk number 1, 2, up to 7. And in the first set of columns, I've got the likelihood. And the likelihood, I'm either assigning one of 2 likelihoods. It's either an expected annual frequency or it's a probability. So if you've got this model in front of you, if you would have been sent an email in which you can download this model, then you should be able to play with this yourself. You've got the expected annual frequency. This means it's from a Poisson distribution, effectively. It's saying, on average, how many times would this event occur? You can either do that, and this is per year, by the way, or you talk about the probability that it will occur at all. Right, so here we've got on average, it's occurring 0.2 times a year. Here we've got a 30% chance it will occur within within some time frame that you're interested in. Here you've got a value of 1.2. Well, clearly that's not a probability. It must be an expected annual frequency. It's bigger than 1. So on average, 1.2 times per year. Now, for annual frequencies, when we're trying to model risk, we actually need to talk about, well, how long are you talking over? If you're talking about, on average, how many tornadoes there would be in the next year, that's one number. But if it's the next 5 years, that's a much bigger number. So we need to put in some sense of the time frame, in this case, the years of exposure, which is 2. All right, we'll be coming back to that in a minute. Now, the next thing is, what is the size of the output going to be? And this is a simple model. It only has one type of consequence, which is financial. If you look in Pelican, you will have, like in most things, you'll have many different categories of consequence, like health and safety consequence, you can have environmental impact, etc., etc. But here we're just dealing with financial. So amount of money lost, we're putting a minimum, a most likely, and a maximum number around these three values. All right, and I've covered these already, but it's not the absolute maximum, it's the P90. So the value we feel that there is a 90% chance an individual loss will not be greater than. So this is a single impact. We have to, not the total impact over lots, because that's mental gymnastics you'll never be able to do. Right. So this is in blue. It's a typical thing for us in our risk modeling. We like to put inputs in blue so you know the numbers you can change. This is logic, so white cells, the outputs on a warmer color, so that's what we're finally focusing on. All right, and so what have I got here? I've got a cell with a formula in it. Don't get worried about this formula too much. It's actually quite simple. So it says if C10 is equal to C28. What's C28? C28 is down there. Oh, if it's equal to probability. So if this cell is equal to probability, then that must mean that it's a single impact event, not a repeatable impact, right? And then just a little extra thing here, it says, then if D10, which is the probability, if that's bigger than 1, well, you made a mistake. It can't be this is a probability and a number bigger than 1, so we'll just make sure you have an error, just because I'm a little pedantic like that. I like to make sure that we don't put in wrong numbers. So that bit's not so important, but this is what's important. The Bernoulli distribution, so Vose Bernoulli, because we now know that it's a single event, with a probability of 0.2. So with the probability of 0.2, that's going to come up with a 1. And we're multiplying it by Vose 3-point estimate, minimum, most likely, the P90, and then 0.9 to reflect that that was a P90. So what's going to happen? When this randomly simulates, this number is going to go, you will see in this column, look at this column, if I hit the F9 key, wherever this was probability, a number is appearing here or not. It's appearing if this risk event occurs. It's not appearing if this risk event doesn't occur. So you can see sometimes they switch on, sometimes they switch off. That's kind of covering half the problem, because this column only applies if this is a probability. In other words, it's a non-repeatable event. And I separated it out just to be able to see the columns and the calculations more easily. So here we go. Excuse me, coughing in your ear. Here we can say, well, if C10 is equal to C29, so if that cell is equal to expected frequency, aha. All right, then this is something that can recur repeatedly. Now, what you might think we would do is we would put in a Poisson distribution of the annual frequency multiplied by the number of years. So if it's 0.2 per year, on average, for 2 years, in total, that's 0.4 per year over the period. So we'd expect on average 0.4. That's what the calculation is there. But why don't I simply multiply that by the 3-point estimate distribution as I did before? And the reason for that is simply because if that event occurs more than once, it should be that it can occur somewhere near 9 one time, somewhere near 4 another time. It shouldn't be that they're all exactly the same magnitude. That doesn't make sense. That'd be a strange world we live in. So this function, the Vose aggregate MC, which I'll show you now, ModelRisk view function, you can see that we've got the view function little tool, which is showing that we've got 3 different ModelRisk functions that we can be looking at. We could be looking at the 3-point estimate, which is this distribution here. We could be looking at the Poisson distribution, which is that one here. Or we could be looking at the aggregate. So this is a function called aggregate MC. Aggregate means sum a number of random variables. MC means Monte Carlo. And what this is doing is it randomly simulating, and it is generating a random number of risk events that are occurring, either 0 or 1 or 2. When it sees 1, it's taking 1 sample from this distribution. When it sees 2, it takes 2 separate samples and adds them together. If it sees 3, little tiny dot, it will take 3 separate samples, add them together, and that will be the magnitude of the total impact. And here is the histogram of what that total impact might look like. So in one simple formula, we can put in the frequency, distribution, the input magnitude of the impact, but we allow aggregate MC to change this for us. And so it can do this extremely well. Let me just give you an example. You could see go with Vose, aggregate MC. Now, I might say, in fact, I've got 10,000 risk events. Is that 10,000? That's 100,000? It's 100,000. What the hell? I'm going to go with 100,000. 100,000. So what this function is going to have to do is add up together 100,000 random samples from a particular impact. So give me the sum of 100,000 of these risks that might occur. So I can go Vose, I'll get fancy on you, gamma 2, 3. If any of you are familiar with that risk, our dreaded competitor, then you will know that they have a function called risk compound, and they do exactly this. But here's a problem. This function is designed to generate a single random number. So I'm just going to enter that number in there, and I want to go in here, formula, and now I want to go evaluate formula. Let's see what it does. Let's go Vose aggregate MC 100,000, and then this Vose gamma. Let's evaluate that. So it's figured a number. The number is 9.6. Well, hang on, what's going on? What it's going to do is it's going to make all of those 100,000 risks all have the same value of 9.69. And you evaluate again, and well, okay, it's generated another random number, so you won't see the same thing, but it's added them all together with the same number. We don't want to do that, but we also don't want to contravene Excel's rules. So what we do here is we, instead of calling it a gamma distribution, we call it a gamma object. This means that I'm defining the distribution for that variable, but I'm not taking one sample. I'm just saying you're going to need to take 100,000 samples from this gamma distribution. So I'm going to call it an object, and that's exactly what I've done over here. So instead of using the 3-point estimate, you can see that it's a 3-point estimate object. All right, so put all these in here. You can add them all up at the end. So the output is just looking at, this is an input distribution in thousands of dollars. I'm summing the single and multiple because only one or the other will ever occur. And then I name this as input. This is named as an output. It's a total exposure. This was nonsense. Model risk. I can run a sample simulation. How many am I going to run? 10,000. That sounds okay. Start. See, it's running 10,000 of these guys. And at the end of it, you'll have noticed that if you saw it very quickly, the whole results for you had changed. It had up there a whole bunch of different tabs, but because I'm running a new simulation from a new model, all the tabs that were created from the other model, they will all appear. So here we've got the histogram of the total exposure. We've got cumulative descending. I can insert, I want to see a tornado, and then I can see the influence that each of these individual risks has in terms of the total exposure for the project, for my portfolio of risks. So I can see that risk number 3 is by far the most dramatic in terms simply of its contribution to the uncertainty, of course. If you have another risk that was just one fixed extremely large value, but with 99.99999% certainty of occurring, it wouldn't contribute a great deal to the uncertainty. It would just shift over the risk, and basically you should take it as certain that it's going to happen. I know that I'm running out of time, but I want to just quickly show you one last model, if I may. So this is my very last slide, and it's linking ModelRisk to tomorrow. So if if you're using the Tomorrow software, then you can, and I'm just loading Tomorrow again. So File, pick up that model, and I'll look at the results. It's running a simulation. Now, one of the things that you'll find in the overview, in the main window, you'll find the SID output here. So I don't want these. I'm going to switch them off. Do I have any others I want off? Okay. Now, if I go into the results, you can see that one option I have in the results ribbon is I can save SID. And I can save, for example, for here, I can say the task. Don't forget, this is for the variables that I've already selected. I can save the finish date and the total cost. And if I go OK, what's going to happen is it will ask me where I want to save that, which I happen to already have done, so I don't want to mess up my world. In ModelRisk, then, we can go into the SIDS library. And then from the SIDS library, I can import a new SID. And I can find it, and these are the two SIDs that I had actually built. And click on it, go open. And when you do so, then you've got this information here. All right. And you can click on them, and you can click on the update. If the person that you're working with and in the project planning, they're always using the same location, you just click on the update, it will automatically update. Now, if I select this and go insert the spreadsheet, what happens, it will put in a cell, an array of two cells here. You can see Vose SID, and it's a commercial construction example. That was the name of the project, and it's a task finish date. Now, what happens is that if I hit the F9 key, you can see here, when you hit the F9 key, these numbers are changing. These are the simulated values that came out of Tomorrow. But the really clever thing about it is that these are two separate SIDs. But when that number is being generated, it's representing a certain scenario within the project. But when that scenario was created, this cost was also created exactly the same simulation moment. So these two go hand in hand. It means that I'm not going to, if I build some financial model, I'm not going to have these two as being inconsistent, like an early finish date, but a very large cost. A large finish date, a late finish date, a very low cost. They're completely connected together, even though there might be separate functions. And because they're separate functions, you can build all sorts of things. You can have, if you remember within Tomorrow, one of the things that you could see was a trend plot. You could take all these cost outflows and put them into a spreadsheet and run simulation model on that. But for now, I've built a model. I think everything in the model, if you can go and look at, you will find very simple. I just wanted to add one extra little thing, which is here to try something that people find perhaps a little bit difficult with ModelRisk. And if you want an array of different values to be one variable, so one like a time series, you highlight it, and then in the inputs outputs, you select, say this is an input, or it could be an output, whichever you prefer. By the way, these any variables can be both inputs and outputs, just so you want to know. All right, so we want a range name. The range name is going to be operating cost. So, right, and I want names for the variables. Well, I can pick here just the year, name of the variable. Now, because I've given it a range name, this set of variables here will all be assigned a Vose input function, but they're all connected to each other, as I'll show you in a second. Right, so I can put some units in here. I might as well. Thousands of dollars. Okay. Now let's have a look. The function, the Vose input function, you remember that we just had that to start with, which was its name. Then we had this, which was the units. But now we've got two extra parameters. One is the array to which it belongs, and the other one is where within that array it sits. So this sits at number 1, and this sits at number 2, and so you can see as we go number 4, etc. Now when I run a simulation, I'm just going to It's hacking away at simulation. Then you see the results. If I click on insert, I can insert a trend, and what happens is that the results viewer goes looking for sets of variables that could be called, that were in a series. So there was only one set in here, so we immediately plotted it. Otherwise, it will show us a circle, it will show a list of variables. If I wanted, for example, to put in a histogram, then you can see that you've got here the operating costs. There was a list of them. So I can still I can plot one individual cost if I want, or several of them if I want. So they still exist as independent variables, but also from the trend point of view, it's a complete list that needs to be plotted here. And now you can see when you hover over it that in year 6, you've got a 1% chance of being below 283,000, 25% chance of being below 298,000, etc. And of course, because it's a different type of plot, it has a number of different options that you can choose for customizing the graph. Okay, well, that's the end of my lecture. Thank you very much for attending. Just to point out to you that the webinar will be recorded and will be available for you to download from our website. If you have any questions that came out of this webinar, please feel free to send an email to my colleague, Steen, who has already been contacting you to give you details about how to join this webinar. So ask your questions, let's see if we can answer. Please remember that our job is in fact that we're consultants and trainers in risk analysis, and that we sell risk analysis software. So if you find yourself interested in any of those aspects, please again feel free to contact us.